Hello, and welcome to the first of what is CHU's new online educational series. My name is Steve, and throughout the year, I'll be hosting conversations that are topical and relevant to all things relevant in the world of Strata insurance. We have prepared a terrific slate of subjects and speakers lined up for you in the coming months. And just as a sort of teaser, we'll be having deep dives into residential cover. We'll be talking about the current state of play in the strata market, and we'll also hear about how to insure complex properties. But I want to throw it over to you. What do you want to hear about? What do you want to discuss? The chat is now open, and what I'd really love is just to hear your thoughts and opinions on what topics or subjects, conversations do you want to hear about or do you want us to tackle in this online series? As part of my role as the experience manager here at CHU, it's to really create moments that matter. So what we want to do is create a series that's really valuable for everyone that's taking time to register for these events. Before we get kicked off, let's just get the housekeeping out of the way. As mentioned, the chat is now open and we do have someone monitoring that live. So if you hear any of our speakers today, raise a point, raise a question that you'd like to answer or comment on, or you want clarification on something, we will have someone in the chat that's monitoring that and answering you live time. So please don't be afraid to jump in there and also make those suggestions about what topics and discussions you want to hear from in the future. You may have also seen a QR code in that web link invitation that we had sent you in the registration to this event. That was included a short 3-question poll or survey that we would really encourage you to provide your thoughts and insights on that, as it is relevant to today's topic of conversation. So if you haven't already done that, the QR code on your screen, just scan that now, answer those 3 questions, and we'll share the results of that survey with you at the end of this conversation in the chat. So we'll do that. We'll get that sorted. And then lastly, I want to talk about continual professional development points. As you may be aware previously, and we're still honoring that, you are eligible just by registering today for continual professional development points or CPD points through ANZIIF and SCA. So shortly after the conclusion of our conversation today, you'll receive an email with a certificate of completion that will make you eligible to receive or redeem those CPD points. That's all the housekeeping. So with that being said, I'm super excited to welcome my first 2 speakers for this initial conversation, where we'll be discussing the topic of underinsurance. My colleagues Fraser and McInnes are here with me today to talk about how do we identify it, what even is it, what are the risks associated with it, and how can we tackle this topic of underinsurance. Really excited to get involved in this conversation. Welcome to Strata in Conversation.
Thanks, Steve. Great to be here. Good to see everyone again. For those that don't know me, I'm Fraser. I'm the head of Underwriting Service Delivery. So I basically look after our underwriting operations at CHU.
How are you going today?
Pretty good. I'm very excited to get stuck into this.
Me too. Cara, how you going? Nice to see you.
Yeah, I'm good. Nice to see you too. Thanks for having me.
No.
For those who don't know me, my name is Cara McInnes. I am the National Claims Service Manager here at CHU, and I am responsible for all things service delivery and operations within the claim space.
I am super happy to have you both, and you can see by the number of people that have already logged in today that we're really eager to get in and start talking about underinsurance. So I think there is only one place to start, and I'll start with you, Fraser. The big question: what is underinsurance?
I thought you'd ask me that, Steve. So in really simple terms, underinsurance is just this. It's when something goes really badly, the insurance isn't enough to put the building back the way it was. That's our definition of underinsurance. That's all it is. On paper, everything can look fine. You know, the policy's in place, premium's been paid. But when a serious claim happens, the money runs out before the rebuilding does. And that's sometimes where you can suddenly discover that there's a gap that someone has to fund. And the reason that people should be genuinely caring about this is that you almost never find out if you're kind of underinsured in a small claim. You only really find out in the worst moments.
I was about to say, that sounds like something pretty important you'd want to know about.
You'd want to know about that, right? So there's a big fire, there's a major flood, there's some kind of major loss. You know, the stakes are really high and the options are limited at that point. And it's not really a small problem when that happens. as some of the people in the audience might be aware of. I just want to show you something on your screen really quick. You'll probably see some general statistics on underinsurance in Australia. And if you have attempted to answer the Slido questions, this might actually answer question 1 for you. These numbers are a little bit confronting, and they might surprise you. So firstly, according to ASIC, around 80% of insured property assets in Australia are underinsured to some degree.
Wow, that's
it's high. On top of that, nearly a quarter of households have absolutely no building or contents cover at all. And on average, sums insured are about 20% behind the true cost of a rebuild. So it's not really a strata problem or even a standalone home problem. It's bigger than that. It's an economy-wide issue that we all need to tackle. It only really gets solved when everyone on this call comes together to play their part. Owners, brokers, strata managers, and insurers together.
That's really good lead into the sort of what I was just thinking as you were going over those figures is, why are we hearing about this? Like, it seems that we're hearing about underinsurance more and more now than, let's say, like 10 or 20 years ago. Is that just me? Or it just seems that, like, in all of the industry conversations or when I'm looking at articles, it feels like this is a topic that's coming up and it's really, like, relevant. Is that just me?
No, I don't think it's just you. And the short answer is, I think that the world has just changed faster than sums insured have. If you go back, 10 or 20 years, building costs used to move pretty steadily. Natural disasters were less frequent. Supply chains were stable, and valuations didn't really fall out of date as quickly as they have been. Yeah. Now, in the last 5 years, that kind of has shifted all at once. So you might remember that mid-COVID and post-COVID, construction costs just jumped through the roof. Labor was scarce, material costs were volatile. And at the same time, we actually had this really unfortunate run of large-scale disaster events. And that started in 2019. So there's a 2019 major bushfire event.
Yeah.
Cara will discuss that later.
Yeah.
But then there was all of the East Coast flooding, which was one of Australia's biggest insurance disasters at the time.
Yeah.
And that really exposed how big the gap had become between insured values and the real cost of a rebuild. And I think that's the key point I want to make. Underinsurance just like didn't suddenly appear. It was already there. It's just that these events revealed it. And on top of that, a lot of valuations just weren't being updated enough to keep pace with how quickly those costs were moving. So yeah, I'll say that it's not one single cause. It's just that inflation, disasters, outdated valuations, they all kind of lined up at the same time to create almost like the perfect storm.
Got it. Okay, so you've just said a word there that I was really listening to what you're saying. You said the term valuations, and they're just not got that valuation right. So from a practical perspective, let's talk about, whose responsibility is that to get that valuation right? Like, I know we have a number of roles that play a part in our industry, and a number of those roles are on this call right now. So I just wanted to understand better, like, whose responsibility, where does that lie, getting that valuation correct?
Short answer, I think it's a bit of everyone. So legally, the declared value must come from the insured. That's the number the policy is based on and priced on. But in reality, that number doesn't really appear out of nowhere. It's shaped by advice from brokers, it's input from strata managers, and I guess it's the processes that insurers put around that as well. So really, it's a shared responsibility. Now, I will say that in strata, we have more guardrails than in a standalone home insurance market.
Okay.
The people on the call here today will know there are legal requirements to insure a building for the full replacement value. There's a formal valuation process in place. There's collective decision-making from owners' corporations. All of those things do help. But those processes only really protect you if they're actually used and taken seriously.
Yeah.
And I can appreciate how hard that is in the real world. And I know that a lot of you on the call today are having these conversations with communities who are under budgetary pressures. They have 10 competing priorities. They might see valuations as an easy cost to kind of defer.
Yeah.
And those are the situations where even a few $100s can be a tough sell. But what we're trying to do today, what Cara and I are trying to do today is to try and give you some better information to arm yourself with, and the insurer's perspective. So when you're having these tough conversations, you're not just saying, well, this is a good practice. you can explain really carefully what the consequences are if that value is actually wrong.
Understood. And what a good point, because you mentioned Cara and her perspective from claims. So let's get Cara involved. Cara, why don't we bring you into the topic of underinsurance and how you see that from the claims perspective? And I know you've brought along a number of case studies to discuss with us, but before we do that, why don't we talk big picture in how you see this, and like how do events like extreme weather play a part in underinsurance and, you know, the cost of insurance generally across Australia?
Yeah. So in relation to bigger picture, the first thing I want to say is, you know, we've been talking about extreme weather, right? That's not the only time we're going to see underinsurance play out. One of my case studies today does not involve a catastrophe event. So I'll get into that a bit later. But bigger picture, from an extreme weather perspective, is that those weather patterns, they've climbed very quickly. And it has been climbing for a long time. If you look at the ICA data that's on the screen, the economic impact of extreme weather has more than tripled over the past 3 decades. Insured losses from declared insurance catastrophes have increased from about 0.2% of GDP. Now it's between 95 and 2000, but that's actually increased to about 0.7% of GDP just over the last 5 years. Now, when you translate that into dollars, over the last 30 years, the insurers have paid an average of around $2.1 billion per year, and that's just for extreme weather events. That is a huge figure.
Yeah, that's massive. That's massive.
It is. It's massive. But, I mean, if we just look at the past 5 years, that figure equates to $4.5 billion a year. That's more than double. And floods are one of the major drivers in that figure as well. The events we're seeing, they're happening more frequently. When they are happening, they're more severe. So the trends from a claims perspective are really clear. Events are costing more, they're happening more regularly, and the severity's increased as well.
That's a really good point. I just want to jump in and add something as well. If you have a look at the third graph on your screen, so the one at the far right-hand side, this is showing total premiums collected by insurers in Australia.
Yeah.
They've grown from about 50 billion in 2012 to about 86 billion in 2023. Really not a surprise that Australians are paying more for insurance. But
yes,
what this graph also shows is that insurer profits haven't really kept pace with that escalation in cost. They've stayed fairly flat. So when people see premiums rising, it's not that profits are rising at the same rate. A big part of that is simply that reinstatement costs are higher.
I think you just nailed it on the head there, because I was just trying to get my head around what you and Cara are saying at that pace. And if I've understood correctly, it's not only, as Cara said, it's not only about extreme weather or more storms or more floods or more this. It's the fact that it costs, the rebuild costs are moving at a pace that the insured amounts are not keeping up with. If that's, you know, and that's where underinsurance gets highlighted. Is that right, Fraser?
Yeah. 100%.
Yeah, right.
That is exactly correct. So that is basically the backdrop to the 2 cases I'm about to show you.
So let's dive in. I know you brought a couple of claims examples. So before you do that, though, I want to make sure that people are pulling out, you know, like the right. What should they be listening out for in these? Because I know you've got a lot of information to share. What should the sort of overarching message be that we're looking for here?
Yeah, so I brought 2 very different examples today. They both involve underinsurance.
Okay.
One's a good story, one's not so good story, but 2 things to listen out for. The first one is just how quickly the gap can open up between the sum insured on the policy and the actual cost to rebuild.
Yeah.
Secondly, is what actually happens when a major claim happens, because that's where underinsurance becomes a very real funding problem for owners.
Okay. Go for it.
So I'll take you into the first case study. So this one is from Malua Bay in New South Wales. This was following the bushfires in January of 2020. Now, for those of you that remember, this was a really significant bushfire season. There was over 24 million hectares that was ravaged by fires, and it also destroyed 2,500 homes. I will also add that it wasn't just properties that were damaged. There was around 3 billion animals displaced and injured as a result of those fires. And as an animal lover myself, that news absolutely devastated me. And well, climate change has been noted as a significant contributing factor to the effects that those fires had. That year in particular, we had record-breaking heat waves, and that greatly reduced the rainfalls in the weeks leading up to the fires themselves. This property in question, it is a 7-unit strata building, and it's got a declared building sum insured of $3.4 million. Okay. Now, as a result of the bushfires that ripped through Malua Bay, 4 of the 7 units were completely destroyed, and you'll see that in the first image.
Yeah, right.
The second image you'll see is the slabs. Now, that damage was so considerable that these buildings needed to be completely demolished and fully rebuilt. And I think something that gets forgotten about in some insured is that if the worst was to happen, demolition costs need to be involved as well. It's not just how much it is to rebuild your home. Yeah?
Yeah.
The really interesting thing in this case was that the remaining 3 units, they were completely unaffected, basically. If you can see in the image, there is almost no damage. Even their gardens are intact, but yet 4 of those units right next to them, completely destroyed.
That's off. Yeah.
Yeah. It doesn't just pick and choose. It will take anything. So the total cost to rectify and rebuild the damaged units was around $2.8 million. Now, in this case, the building was adequately insured for this incident, and the claim could be managed and settled so that all 4 of those units could be rebuilt. Now, yeah, so however, this example does also highlight just how fine those margins can be. With a sum insured of 3.4 mil, even if 1 more of those units had been destroyed, that sum insured would likely have been exhausted. And that would have created a really difficult outcome for everybody involved. And you can imagine the stress that would have caused. Not only has someone lost their home and all of their belongings, but they might also be liable to contribute to a rebuild cost. And that could be in the hundreds of thousands of dollars.
Yeah, that's so significant. The way you've painted that story just makes it so clear as to why this is so important.
Exactly. So, look, when a building is adequately insured, insurers, strata managers, brokers, and builders, we can all work together to achieve a really good result. However, when underinsurance is present, the process becomes significantly more difficult for everybody involved. And the stress and financial impact can be really substantial. So to underline this point, another strata building that was on the same street, that was a 6-lot development, and that was completely destroyed in the same bushfire. That is in the 4th image. What I will say is that CHU did not insure that building at the time of the event, but had it been insured for, say, a similar sum insured to the first example, it would have been an extremely challenging situation, and the insurance funds clearly insufficient to rebuild what was lost. For this one also, some risks, they cannot be predicted or prevented, right? But ensuring that buildings are insured to an appropriate and up-to-date value is something that we absolutely can control. And this case study in particular clearly demonstrates the importance of preparation when the unexpected occurs and just how close these particular owners came to an out-of-pocket loss.
Yeah. So weren't those fires just devastating? Do you remember? I remember those views of Sydney Harbour in the daytime. It looked like the evening because of the smoke in Sydney. Do you remember that?
It was horrible. Yeah. It was absolutely horrible. I remember seeing images of Australia and where all the bushfires were. Yeah. And I was just like, oh my God, it's like Armageddon. It was absolutely devastating. And it was, right across our nation. I've never seen anything like it, to be honest with you, from a bushfire perspective. But that shows you that's a kind of good story, right? We were able to do everything we could, get those properties rebuilt. Everything was good, right? What I want to do now is take you through my second case study. Now, This relates to a significant loss event at a strata building in Moorebank, New South Wales, and this happened in September of 2024.
Okay.
Now, this was a fire. It was not a bushfire. It was not an extreme weather event. It was literally just a fire. And that fire ripped through the entire structure. So in contrast to Malua Bay, like I said, not a catastrophe, but this is just a single incident that occurred totally within this property only. At the time of this loss, the building sum insured was $2.7 million. So for those who are unaware of what a sum insured is, that is the maximum amount available under the policy that we can use to rebuild the property.
Yeah.
Now, following that incident, the covered rectification and rebuild costs reached the full 2.7 million policy limit. So in other words, the insurance responded exactly as it was designed, but it was only up to the declared value. Now, don't be shocked. The figures are big. This building in particular, to fully reinstate it and rebuild it, it was $3.8 million. Now, quick math, that leaves a deficit of $1.1 million. And unfortunately, that's a cost that these owners now have to bear. And they're left to fund the shortfall. What I will say is this committee had done everything right. They'd sourced their valuation. I mean, we've been talking about valuations through the majority of this. They did that in September of 2022. They used that valuation figure to set their building sum insured. And not even 2 years later, here we are. That valuation's out of date and they're left with a shortfall of $1.1 million. Wow. It's just, I can't even begin to imagine the feelings that go with that.
Yeah.
Can you imagine as owning your unit and being told, collectively we need to come up with $1.1 million? Like you've literally just lost everything. I can't even begin to imagine the feelings that go behind those conversations. But I mean, this claim is a really clear example of underinsurance and where a building has suffered what is effectively a total loss, yet the sum insured was insufficient to cover the reinstatement and rebuild costs. And it does highlight the real financial consequences of undervaluing a building and reinforces why those accurate, up-to-date declared values are absolutely essential and just how quickly they can become out of date, meaning proactivity on those is absolutely paramount.
Okay, so I think that there's a common theme here, and it all sits with that initial valuation or that ongoing valuation, as you had mentioned, that 24-month period where that completely shifted. So let's go back to Fraser and ask, from where you sit, like, what do you see, or what's been the biggest surprise for you about those valuations over the last 24 months, 3 years? Or what have you seen?
Yeah. Great question. And I think honestly, the biggest surprise is just how quickly those building valuations fall out of date. And Cara, your Moorebank example is just like a prime illustration of that. People set a value that feels quite reasonable at the time. And then a few years later, the world's moved on. Construction costs have jumped. Labor's more expensive. Regulations have changed. And suddenly the cost to rebuild is a long way ahead of the number that's still sitting on the policy. But what's really changed in the last few years is the speed in which that happens. As I said,
yeah. So sorry to jump in there. I just wanted to but what do you see? Like, is it what you've just said around the building costs, the materials? What do you see as like what's driving that sharp increase in that jump? Like, I mean, as you said, Cara's example is perfect. Like, what's really underneath that? What's driving all of that?
Yeah, if you look at the underlying reasons, it's simply because building costs have increased from a different pace from everyday living costs. And I want to show you something to just highlight this.
Okay.
You have a look on your screen at the moment, you'll see a very colorful graph, which does paint an interesting picture. It's showing the difference between normal inflation and building cost inflation. Now, CPI, which is the blue line on your graph here, CPI is kind of the broad metric that represents the average inflation across everything. This is the metric that you hear about on the news. Now, when I talk about house construction metrics, they kind of represent the subsection of CPI that relates specifically to building and construction.
Okay.
Now, historically, those building inputs have aligned pretty well to the value of strata buildings and also to strata insurance claims cost inflation. But I'll talk about that in a second. Now, The orange line, the one that has that
Right.
massive mountain in the middle there, that one is house construction inputs. So that's the cost of materials and labor used by the building industry. So, for example, the cost of timber, the inflation in the cost of timber.
Yeah.
House construction outputs, which is the kind of light green line, which has a slightly delayed hump there, is the inflation in the price charged by a builder. So what we've seen is that one tends to be a little bit more sticky. It kind of lags behind the inputs index. And that's because there are there are upfront quotes, and there's contracts locking in prices while those input costs are kind of still moving.
Yeah.
Now, thankfully, as you can see from the drop off after the orange line after about the beginning of 2023,
Yeah.
the construction inflationary pressures kind of come off the boil, and it's back down to that nominal CPI level, or even just below that nominal CPI level. But
Yeah.
as you can see from our sums insured indexing, this is how quickly our sums insured for the risks under our cover are moving. Now that's represented by the darker green line, the CHU SI change. It's obvious kind of in hindsight that valuations just simply couldn't keep pace with the level of inflation that the building industry saw mid-COVID. And as you can see, sums insured didn't spike at the time, along with the rebuilding cost. But it has meant that the green line had to continue to stay a little bit higher, despite all of the building inflation metrics settling down, but simply because it needed to catch up.
Yeah. But when you look at that, the second chart, like, I mean, I'm not an economist, or like, I just want you to break this down for me. What's the main story there on that second chart that we're looking at?
Good question, Steve. So the data on the charts are the same. It's just visualized a different way. This second chart is telling a time story.
Yeah.
The first one was what was happening year by year. And this one is showing what happens when you kind of add all that up over time cumulatively.
Got it.
When you look at it this way, I suppose that the main message is just how big that gap became during that spike in building costs around mid-2021. Costs rose super, super sharply in a really short period of time, and sums insured, the green line, the dark green line, didn't move anywhere nearly as fast. So I'd say even though inflation has eased, and you can tell from kind of the flattening out of that orange line at the top there, a lot of buildings are kind of still in catch-up mode. So they're not falling behind further, I would say, but they haven't fully closed the gap on what they should be insured for. So simply, this chart is showing us that for many buildings, the problem isn't really new inflation. It's just unfinished catching up.
So when you raised the point around communities there. So let's talk about those communities. So across the portfolio that you're responsible for and looking after, specific to those communities, is that what you're saying? Like, that, are they keeping up with those changes? Are you seeing a lot of buildings that are falling behind that, or are really at risk? Like, well, what are you seeing, in your portfolio?
Look, for the most part, people are doing the right thing, which is great to see. But I want to show you a little pie chart on your screen at the moment. These are the buildings under our cover, and what they've done in the last 3 years. So when you look at what's been happening to construction costs, you'd probably estimate 5% per year over the last few years. You'd expect that most communities would be actively reviewing and updating their sums insured.
Yeah,
I mean, like, for a few years there was a 15 to 20% year-on-year inflation in building costs. So what this pie chart is showing us here is that over the last 3 years, 7% of our risks have outright rejected an indexation altogether. So they haven't increased their building sum insured at all, even in line with CPI, which is concerning. About a third, so the orange part, have allowed for a CPI increase to flow through, without providing or seeking an updated valuation. And the green sector is risks that have sought and then provided to us an updated valuation. Now, it's not necessarily saying that those buildings are underinsured, but it does kind of show a pattern of behavior that is more reactive than proactive. And I suppose if I bring this back into the context of this meeting, this is where the role of the strata manager and the insurance broker really becomes important. Making recommendations about valuations and sums insured. It's not just part of the quoting process. I think it's a really genuine duty of care to make sure that these owners are properly protected. Now, I know, yes, there are legislative minimums around periodic valuations, and those do vary from state to state, but really, they are just that. They are minimums. just to imagine, Steve, if you lived in a house in 2019, you got a valuation done in your strata, and you plan to update that in line with legislation in 2022, but you had a total loss before that happened, it's entirely realistic that a rebuild cost could have been 50% higher in that time.
Yeah,
now,
we just have a story like that.
Yeah. I really do think that committees should be armed with the knowledge of this current inflationary environment, and given recommendations either for really regular valuations, and that includes working with valuers to protect them against inflationary headwinds before the next valuation is organized. Ask them to.
So sorry to jump in there, because I think you raise a good point, because I think we're talking about what that resolution or what that plan of action could be. But what I want to do is pull a step back and ask you, in your experience, in your role, what are some of those common mistakes that you think or you see that some of these communities are making, and they may not even be realizing they're making them? So I think that would really help the people that might be listening on the call right now to go what are those points of intervention or those risks that we can see that are occurring that we can come in and help or assist with?
Yeah, I think that the most common mistakes are not usually dramatic ones. They're kind of small assumptions that people don't realize that can have big consequences. Like an annual valuation. I understand that it's a tough ask for a few $100s a year to raise for an annual valuation instead of one every 3 years. But I tell you, Steve, it's a few $100s split between owners is a much easier pill to swallow than finding millions of dollars split between owners after a loss. Yeah, like we saw in Kara's examples. But other pitfalls that people can fall into is that people don't actually allow for what a rebuild actually involves today. So older buildings or buildings in certain locations, often they can't be rebuilt the way they were. They have to be updated to meet current building codes, fire standards, accessibility requirements. Sometimes balconies need to be redesigned. Cladding needs to be changed. So all of that adds cost, and it's really hard for those things to be estimated if a valuation isn't really thorough. Now, yes, valuers do carry professional responsibility for the accuracy of their advice, but again, it's a lot easier to ensure that a valuation is robust to begin with than going down the avenue of a PI claim against a valuer, which may or may not be accepted due to the length of time since the valuation was sought. So I'd say another common trap is that assuming that all policies respond the same way when a building is uninsured. It's really important to know that some policies simply cap a claim at the declared building sum insured. That's what we do at CHU. We just cap it at that total BSI. But other insurers, and this is really important to look out for, other insurers may apply what's called an average clause, which actually reduces a payout of any claim in proportion to how uninsured the building is. Really important. So it may not even be a total loss, but owners find that their small claim has been reduced due to the fact that their entire building is underinsured. Yeah. A lot of owners and committees don't really realize that difference until they're in the middle of a major claim as well. Yeah. So summary, 2 major mistakes: underestimating complexity of a modern rebuild, and also not understanding how policy behaves if that value turns out to be wrong.
So I'm conscious that this series is called Strata in Conversation, but I just wanted to go on a slight tangent and understand, is there a difference between the risks of strata buildings and freestanding homes, and what does that landscape look like when it's under insurance?
Great question, Steve, because I tell you, that's question number 2 on the Slido, so it's really topical at the moment.
What?
Yeah, it is.
No, I was just curious, because surely there has to be a slight difference, or I don't know.
Yeah, they are actually quite different, even though they often get talked about together. Okay. In fact, CHU has a standalone home insurance product, which I'll talk about in a second. Okay. But in general, strata buildings are a bit more protected against underinsurance, and that's mainly because decisions are made collectively. There's also, like I said, formal valuation processes. It's required to be insured for full replacement value, and the periodic valuation requirement as well. So yes, there are more guardrails in place. With freestanding homes, it's a lot more informal. I would ask the people on the call here, for those that own their own home, when the last time they sought a valuation for their home was for purposes of insurance. And I'd be incredibly surprised if anyone put their hand up for that. Most homeowners never get a professional valuation. You're relying on online calculators, rough estimates, or even maybe what you paid for the house. And I think that's where a lot of problems start with freestanding homes, because the market value and rebuild costs are two very different things. And on top of that, homes change over time. You know, people renovate, they add rooms, they do DIY work, they upgrade kitchens, and none of that really gets reflected in the sum insured.
Yes.
So in Strata, I think the risk is about values drifting out of date over time, whereas in homes, the risk is more about that starting number being wrong in the first place.
So that's so true. Like, a lot of that resonated with me, as, you know, like, people do DIY or change the home, or, like, you know, upgrade the home in some way. And you're right, that would absolutely change, like, the valuation or what that should be 100%. But you mentioned something about CHU introducing a home product. That's right?
Yeah, it is. Yeah, we've introduced it for homeowners living in community associations, and that insures the individual homes within those schemes. So I think we have about 3,500 lot owners insured under that product, and the cover's actually held in the lot owner's name. And the reason I'd like to talk about that is because, being freestanding homes, there have been some product differentiators we've had to add just to protect owners against that risk of underinsurance that don't have the guardrails in place that Strata has. So the first one we've included on that policy is the building sum insured safeguard. And when that's added in, CHU may pay up to 30% more than what the building sum insured is that's shown on the schedule. Now, we don't tell an insured what to insure for, how much to insure for, but we do have a pretty strong understanding of what an adequate sum insured looks like for a particular home type and location. So the safeguard works by kind of checking whether the sum insured that's selected falls within an appropriate range. And if it does, the sum insured can be uplifted in the event of a major loss. So it protects the customer if they're unintentionally underinsured, and they can see that range in the quoting period. And if they select within it, they can see that they get that sum insured protection.
Understood.
Now, secondly, it also includes really slight periodic sum insured adjustments. So both building and contents sum insureds increase by 0.5% each month of a policy period, just to help keep pace with rising replacement costs over a 12-month policy term.
Understood. I think we're 30 minutes into this conversation or so, and the one word that's, like, we've repeated and repeated and repeated is valuations. Ensure that's correct. So and you spoke about having that independent valuer, and that's one of the parties that's involved in this whole landscape of what we call underinsurance. So what I wanted to talk about is valuations and your view on, like, whether the element of there's a little bit of judgment in that. And I wanted to understand, as we move forward in time from where we are today, do you see those valuations becoming more data driven, or will they rely on, as you had mentioned, independent valuers to always give their personal estimate that could, you know, differ from another person? How do you see that going to drive to that more accurate solution, if that is accurate, or estimated solution?
Yeah, I think you're right. I think valuations will probably always be a bit subjective. They'll always kind of involve some level of human judgment. But buildings are really complex, especially strata buildings, and no two of them are exactly the same. But what's changing quite quickly is how much we rely on a single number to do all of that heavy lifting in terms of price. Just to give you a bit of background, historically, insurers have known that some insureds are often imperfect. It's not a perfect science. So the industry's tended to kind of, like, build in a bit of a buffer in pricing to protect against under declarations.
Yeah.
It's a really blunt way of managing that problem. What's different now, though, is that we have a much larger amount of data that we're pulling on from the actual buildings under our cover. And over time, and we've been in the market for 50 years, as people would know, we've built up a very detailed bank of information about how individual buildings behave in claims. So construction type, age, materials, defects, history, exposure to weather risks, all of that.
Yeah.
As we've gotten better and more mature actuarial models, we've become better at kind of tuning that data and turning it into meaningful pricing. Our data we have now spans construction, roof types, floor area, cladding, defect rectification history, surrounding risks, and granular weather exposure. 20, 30 years ago, you used to have one rating for the weather for your state, and your policy would be based on that rating.
Wow.
Now, after that, it kind of honed down into suburb level weather ratings and then street level weather ratings. And now we have individual parcel assessments of weather data per individual lot. So it's really complex, the data that we hold. But I don't think valuations will disappear. They're still quite important as a financial limit, but I think that soon we'll see some sort of departure from being such a big source of truth.
Okay. But sticking on that term, if I'm asking a question on behalf of a strata community or lot owners, and we heard about Fraser's recommendation or a tactic around not relying on valuations that are done sparsely, right? So if I insure for the right amount, I've got the valuation, I insure for the right amount, my premiums could go up. My question to that is, in a cost of living crisis, how does the industry as a whole, not only CHU, how does the industry balance doing the right thing but also making insurance affordable?
Yeah, look, I do think this is the hardest question in the whole discussion, because at the really simple level, there's an uncomfortable truth. If you insure for the right amount, it usually costs more. There's no way around that.
Yeah.
What's driven that in the last few years isn't insurer behavior so much as what's happened around the world. We've already talked about construction costs through COVID. We've had major catastrophes. We've talked about that. But the cost of rebuilding today is very different to what it was 5 or 10 years ago. And part of that is because of our supply chain issues and material costs. But I think what's misrepresented or underrepresented is the level at which Australian property insurance is influenced by reinsurance. There's only a handful of reinsurers globally who pool their risk exposure. So when there are big losses from floods here on the East Coast, or if there's hurricanes or wildfires in the States, or if there's earthquakes in Japan, those global losses flow straight through into the cost of protecting Australian buildings as well.
Yeah.
So premiums haven't gone up because insurers suddenly want to charge more, but because the underlying costs of rebuilding and protecting property has gone up. Now, the part that's important for this audience is, even with all of that, strata insurance is still relatively affordable compared to standalone home insurance.
Okay.
Now, when we look at affordability, we look at it as a share of income. Now, home insurance is around 1.5 weeks of gross income each year. That's what people are paying on average in freestanding homes. Strata, on the other hand, is closer to half a week's worth of gross income. So there's still a bit of a buffer there, which is really important, because when we think strata, it's got such a nice reduced barrier of entry to home ownership. We'd love to see insurance costs stay low as well. But I think the real balancing act that the industry has here is that we can't make insurance affordable by underinsuring people. That's not solving the issue. It's moving the pain from premium time to claim time. The only way to really manage affordability, I think, is to price risk more accurately, reduce uncertainty, and over time maybe reward behaviors that genuinely are reducing risk exposure.
So this is the hot seat question then. So we're not talking broad. So where we have a building that is investing in being more safer and more resilient, do we ever see a time genuinely that leads to lower premiums?
Short answer, yes, that's where the industry's heading. We're not there in a fully consistent way yet,
Okay.
But definitely where we're heading. So historically, insurance has been much better at pricing risk than it has been about recognizing risk reductions. We could see where the hazards were, but we didn't always have good data about what individual buildings had done to make themselves more resilient. But that is starting to change. And as we get better data on things like construction standards, wind resistance, bushfire, flood mitigation, we can start to distinguish between two buildings in the exact same location that actually present two different levels of risk.
Yeah. Right.
So yes, in practical terms, that should mean that over time, we should see lower premiums for buildings that are genuinely reducing their exposure. And we are actively looking at ways to introduce that at the moment. Now, you can imagine, Steve, in North Queensland, it's going to be that wind-resistant features in buildings are going to start to matter. In bushfire-prone areas, like our Malua Bay example, we're going to see defensible space, building materials, that will come into pricing.
Yeah.
But in flood zones, we might see drainage additions or flood barriers really start to matter. And the more we can see and measure that resilience, the more we can price for it. And that I like to think of it as like a virtuous cycle. So we have safer buildings, we've got lower risk, and ultimately lot owners have more affordable insurance. I think our aim is to price cover. Our aim is always to price cover based on the true risk that a building presents to us, and while also encouraging communities to invest in improvements that enhance resilience and kind of long-term livability.
Understood. Wow, that was a really a great answer. And I want to move across to Cara, because you've sat and you've heard Fraser's perspective and what we've discussed, and you shared your case studies. I sort of just wanted to wrap this and ask you specifically, if people who are listening today take nothing else away, what are those 2 or 3 things, those main stories or main tips that you want them to take away from this conversation today?
Yeah, look, great question. So if I had to wrap it up all into a nice, neat little package and give you 3 things to take away from today, I think the biggest shift people can make is simply when they're having that underinsurance conversation. Too often it becomes obvious at claim time. And by then it's too late. All those big decisions are already locked in. We can't do anything to change the sum insured. And it as you've seen from the examples, it can have devastating financial impacts at claim time for owners. So we can really only work within the frameworks that have been set up beforehand. But if I did have to narrow it down, the 3 things I would say is, the first is how you treat valuations. A lot of the time, valuations can be seen as compliant tasks or an admin cost that can just be pushed out. But from that claims perspective, they're one of the strongest controls that you have. A good up-to-date valuation just makes everything easier when something goes wrong. And when it's right, we see fewer disputes, less uncertainty, and much clearer starting points for everybody involved. The second point I'll say is not leaving the underinsurance conversation until you're about to hit renewal.
For sure.
We do regularly see situations where concerns are raised, but nothing really changes. And that can be because of budget pressures or competing priorities. What matters is that those conversations happen early, and that if a decision is made not to update a value, that it's a conscious decision with a real understanding of what that might mean later.
Yeah.
I know most people in this room have probably been in a situation where you are making a recommendation to the committee, and that does not get taken up. And that will lead me into my third point, which is all around documentation. So I know it sounds basic, but it is so important. If you are making those recommendations and it's declined, just write it down. And that's not to point fingers later, but it's just to make sure that everybody genuinely understood the decision at the time. And because in claims, that often makes such a difference between having what I would call a hard conversation versus having an absolutely impossible conversation. Last thing I'll leave you with is this. Underinsurance almost never comes from one single bad decision. It builds up slowly through complacency and compromises. And the best protection is when insurers, brokers, and strata managers are working together that make those compromises visible early instead of discovering them after the loss has occurred.
Not sure about you guys, but I do not think that there's a better place to wrap a bow on this thing.
Well, it sounds like I can ask you a question, Steve.
Yeah.
Have you learnt a little bit about underinsurance today?
I'm definitely not an expert, but 100% the information that I carried into this conversation versus what you guys have shared has been awesome. And what I can thank you both for is putting that in simple and practical terms and steps and actions, because I even now know what I need to do. I feel armed with the information that I can walk away with and go, oh, yeah, I should consider this. So I thought that was really fun. What do you guys think? I thought it was
Had a great time. Had a blast. What about you, Cara?
Yeah, I had an awesome time. It was really good. And, it's always nice to bring the human element to it, right? Because we don't just deal with buildings. And I know that a lot of this is focused at buildings, but there are humans living in these buildings.
Yeah, definitely.
Everyone should remember that.
So on behalf of all of those that have logged into this call, hey, thanks Fraser and thanks Cara for taking your time and for setting the bar so high for what I'm sure will be such an awesome series throughout the rest of the year. And thanks to everyone. Thanks to you guys for logging in and spending your time. And I hope you really enjoyed and found this conversation valuable for your time. I'm really excited to announce that our next Strata in Conversation will be on Friday, the 27th of February. And what we'll be discussing, we'll be talking about residential cover. A reminder to let me know, to let us know in the chat, or to email communications@chu.com.au. What do you want to hear about? What do you want us to discuss? What will you find valuable that will help you in your roles and the part you play in the Strata world? Guys, Fraser, Cara, everyone, thank you so much. My name is Steve, and I look forward to chatting again in our next episode of Strata in Conversation.